The commodity markets have been concerned about recession lately and what the Fed may do from here. Now, the Fed gave us some indications as they released their meeting minutes on Wednesday. AgDay's Michelle Rook has details.
Clinton, the Fed indicates they're poised to raise rates in July by either 0.5 to 0.75% to curb inflation. They also agree that a more restrictive stance could be appropriate if elevated inflation pressures were to persist, and they think they can do it without sending the economy into recession. The Fed's move doesn't come as a big surprise to many noted economists who are already expecting a hike at the FOMC's July meeting and more down the road. A lot will depend on the latest consumer price index.
We'll see on the 13th of July, the latest CPI, the Consumer Price Index. I expect it to indicate that inflation is already cooling. So the market's already doing some of the Fed's work.
Goss says if that CPI confirms, it may curb the aggressiveness of future rate hikes.
Early on, we were expecting a lot more, but the economic weakness is just out there. So I only anticipate a rate hike in July and then another rate hike in September. That will be an increase of probably about 1 percentage point between those two rate hikes.
He says the Federal Reserve admittedly acted too late, and their aggressive action has now become part of the reason the U.S. is moving into or is already in a recession. Goss adds that their recent survey of ag bankers in the Midwest indicates the higher interest rates are becoming a problem for farmers who are having to borrow more money just to pay for higher input costs.